October 14th, 2024, 9:31 a.m. Eastern. The New York Stock Exchange opens for trading. Within the first 60 seconds, an algorithm has already executed 47,000 individual trades across 312 securities. No human approved these trades. No human reviewed them. No human even saw them. By the time a retail investor in Cincinnati, Ohio finishes typing his buy order for 200 shares of a mid-cap biotech stock, that order has already been read, anticipated, and front-run by a system that operates 12 microseconds faster than the exchange's own matching engine. His order fills at a slightly worse price than it should have. The difference is 0.04 per share, $8 total, not enough to notice, not enough to complain about. Multiplied by 40 million similar transactions every single trading day, it is 1.6 billion per day, extracted invisibly from the accounts of retail investors and deposited into the infrastructure of high-frequency trading firms that most Americans have never heard of. This is not science fiction. This is the current operating state of American financial markets. Comfort is the enemy of survival. The story of how artificial intelligence transformed financial markets from a system designed to allocate capital efficiently into a system designed to extract value from ordinary investors runs through three distinct eras. The first era was front-running, firms physically positioning themselves closer to exchange servers to gain microsecond advantages. The second era was algorithmic trading, using rule-based systems to identify and exploit pricing patterns faster than humans could react. The third era, the era we are in now, is something qualitatively different. It is AI that learns, adapts, and hunts. The firm at the center of the first era was Virtu Financial. In 2014, Virtu's IPO prospectus contained a disclosure so remarkable that financial journalists stopped mid-sentence when they read it. Out of 1,238 trading days over a 6-year period, Virtu had lost money on exactly one. Not two, not 12, one. In 6 years of trading across global markets, through the 2010 flash crash, through the European debt crisis, through dozens of market dislocations, a firm using high-frequency algorithmic trading lost money on a single day. That is not skill. That is a structural extraction mechanism with almost zero variance. Virtu was legal. The SEC reviewed it. The CFTC reviewed it. Multiple academic papers analyzed the market microstructure. The conclusion was consistent. HFT firms were not adding liquidity to markets in the way their lobbyists claimed. They were engaging in a form of latency arbitrage, exploiting the tiny time differences between when an order was placed and when it was executed to trade against that order at a fractional advantage. Legal, disclosed, corrosive. That was 2014. What came after Virtu was something Virtu's founders did not anticipate. By 2021, the major quantitative hedge funds, Renaissance Technologies, 2 Sigma, Citadel Securities, were no longer using rule-based algorithms. They were deploying machine learning systems trained on decades of market data, news sentiment, satellite imagery of parking lots, shipping container GPS signals, and social media keyword extraction. Renaissance's Medallion Fund, the flagship fund open only to employees, had returned an average of 66% annually before fees since 1988. Not 6%, not 16%, 66%. Sustained for 37 years. The gap between what those systems could see and what a retail investor could see was no longer measured in milliseconds. It was measured in dimensions. And then, in 2023, the large language model revolution arrived in finance. What changed was not just speed or data processing. What changed was the ability of AI systems to read and interpret unstructured information, earnings call transcripts, Federal Reserve meeting minutes, geopolitical news, regulatory filings, and translate that interpretation into trading signals faster than any human analyst could read the first paragraph. In March 2024, a whistleblower complaint filed with the SEC alleged that a proprietary AI trading system operated by a mid-sized quant fund had been systematically detecting the order flow patterns of retail investors through analysis of publicly available options market data. The complaint alleged the system could identify, with approximately 73% accuracy, when a large retail options position was about to be established, and position against it before the order was fully executed. The SEC opened an inquiry. 18 months later, no enforcement action has been announced. This is the escalation. 3 steps. Virtu extracts cents from millions of transactions through latency. Renaissance extracts billions through information asymmetry. An unnamed AI system in 2024 allegedly extracts value by predicting your behavior before you act on it. And the mechanism that enables all 3 steps is the same mechanism. It is called payment for order flow. Here is how it works. When you open a Robinhood account, or a TD Ameritrade account, or a Fidelity account, and you place a trade, your brokerage does not send that order directly to the New York Stock Exchange. It sells your order to a market maker. Citadel Securities handles approximately 40% of all U.S. retail equity trades. Virtu handles most of the rest. These market makers pay brokerages for the right to be the counterparty on your trade. They pay because they profit from the spread, the difference between what you pay and what the security is worth at the precise moment of execution. The SEC has estimated that payment for order flow costs retail investors approximately $3.7 billion per year in execution quality degradation. That is the low estimate. Academic researchers at the University of California, Berkeley put the annual transfer from retail to institutional traders at closer to $8.3 billion when latency effects are fully modeled. You do not receive a bill for this. There is no line item on your brokerage statement that says HFT extraction fee. You simply get slightly worse prices, slightly more often, in amounts too small to notice, across a lifetime of investing. The compounding effect over a 30-year investment career is not small. A retail investor who loses an average of $300 per year to execution degradation, compounded at market returns over 30 years, has lost approximately $28,000 in final portfolio value. For a median American investor, that is 2 years of retirement savings. Gone. Legally, invisibly. The SEC under chair. Gary Gensler proposed reforms to the payment for order flow system in 2022, reforms that would have required brokerages to route orders to competitive auctions rather than exclusive market maker relationships. The financial industry spent $300 million lobbying against those reforms. The rule was never finalized. The extraction continues. What replaced the reform conversation was a wave of marketing about commission-free trading, a framing that is technically accurate and deeply misleading simultaneously. You pay no commission. You pay with execution quality. The brokerage earns the revenue from the market maker who front-runs your order. The only party who does not profit in this arrangement is you. And in 2025, AI has added a new dimension to the extraction architecture that regulators are not yet equipped to address. Machine learning systems can now analyze the aggregate behavior patterns of millions of retail investors to predict correlated buying events, moments when large numbers of retail investors are likely to pile into the same security simultaneously. By positioning ahead of that correlated behavior, institutional AI systems can extract value not just from your individual order, but from the predictable herd behavior of millions of orders simultaneously. The scale of that extraction has no historical parallel. 3 extractions. Virtu 2014, 1 losing day in 6 years. An unnamed AI system, 2024, allegedly predicting your behavior before you execute. And the payment for order flow infrastructure connecting them both, running continuously, right now, in every brokerage account you own. The question nobody will answer in plain language is this: if a system is designed to profit by being faster, smarter, and more informed than you, and that system operates legally with regulatory knowledge inside the markets where your retirement savings live, is the market still serving you? Or are you the product?